Jobs. This just looks at absolute number of jobs, peak to trough. We're coming back, but it is still lagging. The point is it looks better in some degrees than it really is. Why? The participation rate. That means there's less people looking for work. That actually makes things look artificially a little bit better. And there's still over 10 million people currently unemployed. But we are creating some jobs, but again, not as many as we would like to see. The big thing, the most interesting thing relative to the unemployment rate is the Federal Reserve. So Janet Yellen, listening to her, obviously all eyes are focused on her right now in terms of replacing Ben Bernanke, who's happily scooted off back to Cornell, saying that when we hit 6%, the Fed funds rate will start to rise. It won't. The reason being is the job creation is still not there. That's a bit concerning for them. Overall, glass half full or half empty markets were saying it's terrible. We were looking at 170, 175,000 new jobs last month. And we obviously came out well short of that. We are still seeing people more, however, getting into the workforce. That's actually going to be a good thing. We created over 100,000 jobs, and that detracted from the unemployment rate. Therefore, the unemployment rate dropped. It is getting better, but it is a way to go. Awful lot of apartment projects. Why do investors like apartments? Well, if you look at vacancy rates, very, very stable. The long-term vacancy rate goes back to 2004. In fact, I can go back to 1996. It's still averaged about 5.5%. We have been a remarkably stable market. The problem is there's a lot of money wants to buy them. However, people that own them have refinanced at very, very favorable rates. They, generally speaking, don't want to sell. So, not a bad year last year. Prices continue to rise. We're even seeing some land transactions now knocking on $1,000 a square foot for land in downtown Seattle. Quite remarkable if you think about it. I think we'll see greater interest in the suburbs. There's no question about it. I think West Bellevue is going to be okay. I think Bellevue in general is going to be okay. I think it's a market which has got more potential. Some select sub-markets in the urban cores, but mainly it's going to start moving out. Redmond, Renton, these kinds of areas, even Mill Creek, Mount Lake Terrace. So less the kind of sexy neighborhoods of downtown. We're seeing a lot of money out there and a lot of money being paid for office buildings, most certainly recently. Some quite scary numbers. But in terms of net new demand, not as much as you would like to think. Downtown Seattle occupancy. We think it's getting better. Yes and no. The other hand. The red represents square footage absorbed by Amazon.com. The green, everyone else. So when we see a market improving, what's driving that market? In the second quarter of last year, we would have dramatically given space back to the market had it not been for Mr. Bezos. So are they juicing the marketplace? Absolutely they are. Apartments are still, this year, I still think the number one asset class. There's still going to be more demand, at least for the first part of this year, depending on where you are relative to supply. Single family homes, the new construction community, if we're running out of dirt. King County dirt values doubled for finished lots in 2013. Office, and that's based upon transactions. We've seen a lot of transactions last year. We'll see some more this year. Is it an improving market? Yeah. But again, we're shoehorning more people. I mentioned the 175 square feet per employee for Amazon.com, 130. So literally, it's amazing how many people they will get into their towers that they're going to be building in downtown. And finally, retail. In terms of spec retail, not there yet. Our buying patterns have changed.